how to make a passive income with dividend investing. Before we get started, if you're new here, make sure to hit that subscribe button below and turn on the notification bell so you never miss our latest content. The premise of passive income is attractive because who wouldn't want to sit back and watch their extra cash silently earn more money without doing any additional work? However, generating passive income is easier said than done. It only comes from legitimate opportunities with the potential for substantial returns. Dividends are a regular payout of your share of company profits when you own stock in a business, and this type of investment can meet these requirements. Consider working with a financial advisor to help you determine how dividends might factor into your investment strategy. What are dividends? Dividends are financial returns investors receive for holding stock in a company. When a company is profitable, shareholders receive dividends as a reward for the risk of owning their portion of the business. They can come in the form of cash payments or stock dividends. How dividends work? When a company makes money, it has a couple of options for what to do with the cash: reinvest to the business or pay dividends to shareholders. If it chooses the latter, each investor obtains a reward according to how many shares they have. For example, let's say a company issues a cash dividend of $1 per share. In that case, a shareholder with 50 shares would make $50 from their investment. A company also might issue a stock dividend instead. Using the same example, if the company approves a 10% stock dividend, the shareholder would receive a proportional amount of additional stock. As a result, they would take ownership of 5 additional stocks for a total of 55 stocks. While the resulting stock dilution would make the total value of their holdings the same as before, and a jump in the stock price would be increasingly profitable. Invest in companies with reliable track records. Just because a company is worth billions doesn't mean it's an ideal investment. The company also needs to pay dividends to its shareholders. As a result, it's a good idea to check the U.S. Securities and Exchange Commission (SEC) disclosures for records of dividends paid in the past. Generally, a company that has paid its shareholders for the past several years will continue doing so. On the other hand, a company with high earnings but no history of dividend distribution may be an unreliable investment for increasing your passive income. Additionally, balance is a factor to prioritize. While a company that pays every last penny of its profits as dividends sounds fantastic, it's not a sustainable practice for a company to have a payout ratio of 100%. In reality, a company that makes steady dividend payments of no more than 60% of its earnings is a strong investment. This way, the company will use some of its earnings to maintain and grow the business, providing even higher returns in the years to come. Profitability and robust cash flow. Companies that generate substantial income are more likely to pay dividends. On the other hand, a company that reports year-over-year losses will probably suffer stock price decreases and shrink its business operations. Therefore, cash flow is vital. A profitable company is likely to have better cash flow, which leads to a higher probability of dividends. Looking through a company's financial reports can help determine whether sizable amounts of money regularly go in and out of its accounts. You're not necessarily looking for the business with the flashiest product or an initial public offering (IPO) that makes headlines. You're looking for businesses sitting on piles of cold hard cash. Use dividend payments as investments. Reinvesting dividends is an excellent way to increase your passive income. Instead of pocketing dividends, you can use them to purchase additional stock. By increasing your exposure to the companies you've chosen, you have higher income potential than before. Reinvesting for multiple years can double your passive income generation. That said, investing always comes with risk, so you also have a chance of losing your extra investments. Time is on your side. Even if your investments seem weak initially, the stock price should increase over time. If you've done your research correctly and invested in companies with solid foundations, they will find success, resulting in stock growth. Additionally, because your stock purchase price is a fixed cost in the past, you benefit the more time passes. In other words, the longer you hold a stock, the more opportunities you have of receiving dividends. For you to make passive income, a profitable company's stock price doesn't need to skyrocket. It only needs to keep passing along profits to its shareholders. Be mindful of risk. While dividends are excellent as a passive income stream, they can fail. Like any other investment in stocks, bonds, real estate, and other assets, there's a chance your dividend holdings will go south. Specifically, one or more of the companies you invest in may experience years of stagnation or go out of business. The risks involved are why diversification is essential. In this context, it's wise to diversify on two levels. Firstly, in your investment portfolio, and secondly, in your passive income streams. You can never eliminate risk entirely, but you can reduce it. Don't put all your eggs in one basket. Instead, thoroughly researched investments among a variety of assets and opportunities will provide more reliable returns. How much to invest in dividends? Your investment in dividends will depend on the stock price, projected returns, and your overall financial strategy. For example, let's say you have $50,000 to invest and have found a company with a stock price of $1,000 per share and a 5% projected annual yield. Buying 5 stocks creates $250 of annual passive income, and your goal is to establish $2,500 of passive income per year. As a result, you realize that you could spend your entire investment fund on this company's stock and reach your goal. $50,000 of stock would create $2,500 in profit annually. However, investing solely in this company will give you no chance of diversifying your portfolio. And if this one company goes under, you will lose your entire investment fund. Since diversifying helps weather market volatility, it's probably wiser to put a portion of your money into this company and look for others as well. Dividends can create hundreds or thousands of dollars of passive income every year. For investors willing to do their homework and mitigate risks, a collection of stocks among numerous profitable companies in different industries can weather economic storms and provide a stream of income in perpetuity. It's important to figure out how these assets can work with your overall financial plan and asset allocation to maximize the benefit to your long-term financial goals. If you enjoyed this video, don't forget to give it a thumbs up and subscribe to Fatty Daddy Reviews for more content. Hit the notification bell to stay updated with our latest videos. Share your thoughts in the comments below. We love hearing from you. Thank you for watching.